The game just changed, and the market is pricing it in. A new batch of labor data just dropped, and suddenly the chances of a Fed rate cut in September have surged. But what exactly changed? Why is this labor report so different? And how should investors interpret this shift? Let's break it down. The September rate cut odds just jumped. Before the latest jobs report, Wall Street placed the odds of a September rate cut at around 48%. But after the data hit, those odds jumped to nearly 70%, according to CME FedWatch. That's a big move, and the reason is rooted in a new tone emerging from the labor market. Not just in the headline numbers, but in the details. The headlines look strong, but the details signal weakness. At first glance, the jobs report didn't seem alarming. Non-farm payrolls rose by 187,000 jobs, slightly below expectations. Unemployment rate ticked up to 4.1% from 4.0%. Wage growth held steady at 3.9% year over year. None of that screams recession. So, what's the big deal? It's the underlying cracks that matter. 1. Job revisions. The previous 2 months' reports were revised down by a combined 110,000 jobs. That means the labor market has been weaker than reported. 2. Labor force participation. More people are entering the workforce, but not necessarily finding jobs fast enough. That pushes up unemployment in a way the Fed pays attention to. 3. Temporary jobs and part-time work are rising. These are often early warning signs of employer caution. 4. Average hours worked per week declined. This is a classic leading indicator. Employers reduce hours before they cut headcount. The message? The labor market is cooling quietly, but clearly. Why this report changes the Fed's calculus? The Federal Reserve has said repeatedly, we need to see clear evidence of a cooling labor market before we begin cutting rates. Well, this might be it. Remember, the Fed has a dual mandate. 1. Price stability, keeping inflation around 2%. 2. Maximum employment, ensuring jobs for those who want them. Inflation is trending downward, but, until now, the jobs market remained resilient. Now, with a rising unemployment rate, lower revisions, slowing wage growth, the Fed may have the justification it needs to cut without looking weak on inflation. Powell doesn't want to look like he's chasing markets or bailing out Wall Street, but he also doesn't want to over-tighten into a softening economy. This report gives him cover. So, what's the base case now? As of now, here's what traders and analysts are betting on. 125 basis point cut in September. Possibly another cut in December if the cooling continues. A year-end Fed funds rate around 4.75% to 5.0%. The Fed's own dot plot shows only one cut projected in 2025, but that projection came before this labor data. A continued trend of soft data may push the Fed to move more aggressively than they're currently admitting. And remember, the Fed doesn't want to surprise markets. If they're planning to cut in September, they'll start telegraphing it by late August, likely during Powell's speech at Jackson Hole. What this means for markets, investors, and consumers. If a rate cut becomes likely, here's how it plays out. 1. Stock market. Growth stocks rally, especially tech and high-duration plays. Small caps may outperform as borrowing costs ease. 2. Bonds. Yields fall. Long-duration treasuries and corporate bonds get a bid. 3. Real estate. Mortgage rates could dip, reviving some buyer interest. Riots may gain ground as cost of capital drops. 4. U.S. dollar softens, especially against currencies from hawkish central banks, may benefit exporters and commodities. 5. Consumers. Interest rates on credit cards and loans may stabilize or decline. Confidence could recover as recession fears ease. But there's one key caveat. If the Fed cuts because growth is slowing too fast, markets may start worrying about earnings, not just interest rates. It's a fine line. Final thoughts. The Fed's path forward isn't set in stone, but this latest labor data tilts the board in favor of a cut. The economy isn't crashing, but it is cooling. And that's exactly the kind of environment where the Fed might act preemptively to avoid doing too much damage. September is still weeks away. But one thing is clear. The odds of a rate cut are higher than they've been all year. Now the question is, will the Fed follow the market, or will the market get ahead of itself? Stay tuned. This is just getting started. Like and subscribe for macroeconomic breakdowns, Fed policy analysis, and real-time updates on markets, rates, and recession trends.